it's worth highlighting that so rates during the 2017, 2018 cut, I think we're at like 3 at their peak, and then the repo market debacle kind of forced them to pivot and cut. And then before that, I mean, I guess like in the early 2000s, rates were like close to where we are today, but like probably 100 basis points lower. But this is like maybe retrospectively, this is the largest rate cutting cycle that we will ever live through, is my view.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub rewarding you to protect the multi-chain. So not only can you protect your own data across any asset and any chain, but you also get shielding rewards for strengthening data privacy protections for everyone. So you can check them out at Nomada.net and follow their mainnet launch. Stick around, you're going to be hearing all about them later in the program.
All right, everyone, welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer, the views expressed by my co-host today are their personal views and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another episode of Bell Curve. Here you got Michael's 1 and 2, Vance, and apparently a man with a chainsaw in Vance's driveway. How you guys doing? How's the week?
Week has been interesting.
I've been reduced to hiding in my theater room.
My theater room for my man building the sauna.
Jesus Christ.
I'm actually in, I'm not too far away from you right now, Vince. I'm in Montana visiting my parents, actually. So I'm in their place out here. Yeah. It's good. I see why so many people move out here. It's just very, like the Mountain West, just very relaxing. Very nice.
What part of Montana?
Bozeman.
Nice.
Bozeman. They actually have a place. They bought a place a little while ago in Big Sky, and they've been renting in Bozeman, but they just finally found the real estate out here is nuts. It goes up like 40% a year. And it's one of those things where you put in a bid and it's like that day gets 25% over asking price. So it's just pretty tough. Yeah. So, but it's cool out here.
GM to you.
GM, fellas. GM. We should, I guess we should get into it this week with some of the, it's been a little while since we were a macro pod, so maybe we can give a quick update because we had some data come in this week. We had an FOMC, and I think there was a little bit of de-risking in crypto going into the FOMC because folks were nervous about people are getting nervous about inflation again. But we had a slightly softer than expected CPI print, and also PPI came in this morning actually, and it's showing flat, not even disinflation, just flat out deflation in the economy. So there was actually a shrinking from month over month, negative 0.2%. So I think basically people are, there's eyes on growth and people are starting to wonder if there's a growth scare. There was a lot of, in the FOMC in particular, people were curious to see what the dot plot was going to show. And the market was pricing in 2 cuts pre FOMC, and the dot plot showed just 1, which people didn't like. There's also something kind of interesting around the neutral rate. So the neutral rate is this like hypothetical measurement of where the Fed thinks neutral policy is. It doesn't really exist. R-star, baby, R-star. It's kind of made up, but they moved their rating of R-stars to 2.6%. They moved it up to 2.8%. So this just implies actually that the Fed thinks that they're in slightly less restrictive territory. And that's important because if the Fed thinks that we're in restrictive territory, then that gives them some breathing room to make cuts. So it was a little bit of a mixed week.
The other element, just to tap in, the other element with R-star moving up is that the expectation was that we would get, and this is where, forecasting with dot plots isn't perfect. It's directional, not precise. But the expectation was for us to be able to get from 5.25, 5.5 down to the R-star rate of 2.6, it would require something like 9 cuts. And so the expectation was, well, they're not just going to be able to do 9 cuts right off the bat, and they're not going to be able to cut 100 it's going to be 25 basis point chunks along the way. And now they're kind of A, shifting the goalposts, B, pushing back the first cut. And that's what kind of gave people a hawkish tone from the conversation yesterday. The other element that was really interesting, I think, and this is the first question during the question section, was a change of PCE expectations from being, I think it went from 2.6 to 2 or 2.6 to 2.7 or 2.7 to 2.8 expectations of where core PCE will be by the end of the year, which basically means that their expectations of their forecast are higher than where core PCE is on an annualized basis today. And so the question was, do you expect core PCE to go up in the next couple of months or next couple of printouts? He didn't have a great answer to that, I thought. It was more just like, yeah, these are forecasts. We'll see kind of where things net out. And, there's the base effect, and it's just kind of like waxing poetic as he stick handles through the questions. The other point that I thought was super interesting, we got the CPI print at 8:30 a.m. Eastern yesterday. FOMC meeting and the press conference wasn't until 2 p.m. So the expectation was, oh, well, there's time, what maybe this is the fully updated version. And he got the question, and his answer was, most governors don't change their mind when we see new data come in during a meeting, which suggests two things. Number one, this was probably mostly what people were thinking about prior to that low CPI reading yesterday. But two, there probably are some governors that change their minds and change their dots based off of the data. I wonder if they would change it further based off of PPI today. But I think a couple of things to kind of take and sum up what happened over the last 24 hours of data. Number one, it seems like inflation is cooling faster than people necessarily realized. It was interesting to see all of the higher for longer inflation pundits coming out yesterday, basically talking about how this was an aberration. The data is inaccurate. There's no way that all of the forecasts could be off this much. And number two, it seems like we're not getting rate cuts pre-election. If there's going to be one cut, which is now where the dot plot suggests, it's probably going to happen in December. There's no reason why they would do it, within a month or two of an election cycle, and then not continue rate cuts, for the rest of the year. So one cut going forward, fewer cuts get back down to R-star, and inflation may be a canary in the coal mine for something broader from a lack of growth perspective.
Yeah, there was one of the other interesting things that this is data that we got last week, but there was we had a jobs report and unemployment the same day, and those are two different. There's a household survey, and then there's this data which gets calculated by the Bureau of Labor Statistics, and they rely on something called the birth-death ratio. So it was interesting because it was a hot jobs report. There was 272,000 jobs created off of 190,000 worth of expectations. It's worth remembering that that typically tends to get revised back down. Like I think they summed up all of 2023. They looked, and it's like 780,000 jobs that they said got created were wiped out. And then at the same time, the unemployment survey showed us increasing unemployment from 3.9 to 4%. And there's a couple of different reasons why this could be. People are, I mean, not to get into politics here, but we've added, like, immigration has been going pretty crazy recently. And that's like a big part of the discrepancy there, because the households that get pulled, don't tend to, it doesn't take into account immigration as much. So I think that's another thing that central bankers look at is unemployment as well. Sorry, Vance.
So if you look at the unemployment report and the jobs report, so there was 0 new jobs created in the last month, but they have this thing called the birth-death model, which is, so they say how many jobs are created, how many people were fired, and then they have this birth-death model, which is they look at the amount of businesses that were started or were declared bankruptcy and shuttered, and they kind of guess at, okay, well, how many jobs would those creations of new companies start? And so the entire jobs report was, that the 270,000 that were created, it was just that birth death. So it's like there were 0 jobs that were really created, but their guess is that 270,000 were actually started. And then you dig deeper into it, and there's been basically no jobs created in the past year for native-born Americans, but there's been a ton created for foreign-born Americans. And I think if you like basically put all these data pieces together, you can kind of tell that we're already in a recession. The unemployment rate for people that, probably are in the middle class or even white collar jobs is probably going up quite significantly. And I've honestly stopped paying attention to the CPI reports and FOMC. Like I watched a little bit of it yesterday, but like the people who say the next move is a hike, I think have actually lost their minds. And if you're in recession or if you're in inflation FUD, you need to pivot to recession FUD. Like it feels like this recession has already happened. We may already be on our way out of it, but because the data lags, the reporting, like it feels like we're going to get like a very recessionary data package over the next 3 or 4 months. So I would probably take, I mean, look, we were supposed to have 7 rate cuts at the beginning of this year. That's what was priced in. It's like almost hard to believe that people were thinking that. And now it's 1. And so I think maybe the least reliable indicator of how many rate cuts are going to happen is the Fed itself. I would either say there's going to be 0 cuts or there's going to be like 5 cuts. And I would probably say that I'd be on there's going to be a ton of cuts by the end of the year, just because I think the data is going to deteriorate. And his whole thing yesterday, the part I watched at least, was we're going to be super data dependent. We're not going to rush to do things. We're not going to, proactively do things. But if the data turns and employment's at 4%, unemployment's at 4% right now, that's kind of the start of the level of like things are getting concerning. So that's my take, at least.
I mean, we can't have 5 cuts because I don't even think there's 5 meetings left. Or there's 5 meetings.
Or whatever. They do like a 50 basis point cut at one meeting and count that as 2 or whatever. But like, I think if the data really turns, these people are going to get pretty nervous and start cutting.
People focus a lot on the inflation, the CPI and PPI, or it's PCE that the Fed really cares about. But unemployment is, remember, they got a dual mandate. There's price stability and unemployment. And people criticized the Fed for basically keeping their foot on the gas with QE for much longer than they should have. But what they were looking at back then was the labor market. And so they look at this really closely. The other thing is this was last week as well, but the ECB, so the European Central Bank, and the Bank of Canada both cut. And the ECB one was
Bank of Canada. First off,
Bank of Canada, baby. Hold it down. Hold it down. But the ECB one was funny because at the same time they cut, they also raised their inflation expectations, which was a pretty interesting data point to look at.
They just don't have as much immigration as the U.S. does.
I'm going to show you. Yeah, here, I'll show you guys this chart. Again, I don't want to make this people get very political over this issue, but this was a chart that went live in the Financial Times this year, which was pretty interesting. Pretty interesting. Yeah. So,
yeah, that's not. I mean,
just to describe what this is the total number of people in the United States who are native born versus foreign born. Mm-hmm. And I can't exactly. So you've got January 15th, January 20, and then I guess the end would be like January 24, maybe something like that. Basically, in the last year or two, it looks like, basically since January 21, it looks like it's the foreign born has just been on a straight line up. But in the last year, it looks like the native born has been actually declining a lot. Mm-hmm. A couple million.
Yeah, and basically, we don't need to get too deep into this, but yeah, I mean, I think that's kind of the difference here. And also there's a lot of, we could go deep into like where jobs are being created. Are they full-time or part-time? It's not full-time jobs, it's part-time jobs. And so, yeah, there's this funny discrepancy in between what the official statistics say and how people generally feel when you poll them. Like there was a poll that I think came out in The Guardian. It's like 50% of people in the US believe they're in a recession. Something like 50% of people believe that the S&P is down on the year. There's just such a huge discrepancy.
No. The craziest one was unemployment is at a 50-year high.
Yeah, that's nuts, because even though I agree, Vance,
that might be more accurate. That might be a more accurate perception that, like, I feel like most people just don't know about the stock market. But like, if you surveyed people and you're like, how's the economy going? I feel like people are, mixed bag at best. It just like the people who are saying that this is the strongest economy we've ever had, like, I feel like that's almost borderline like gaslighting. And, like, people really hate, like, when you're like, hey, the economy's doing great. Are you doing great? People are like, no. Like, what are you talking about? I feel like that is one of the core problems with the Democratic messaging right now. Like, I feel like if they just capitulated and they're like, the economy is shit and we're the only people who can fix it, it'd just do a lot better than saying the economy's so great. Don't you know that?
Yeah, but we're T minus 3.5 months from elections. There's no changing tone at this point. We've crossed the Rubicon.
That's my other favorite thing. People have been like, oh, the election's like 7 months away. Oh, the election's 6 months away. Oh, the election's only 4. It's like the election is like very soon, and early voting starts in September. So we'll see who wins, but it's just not looking good for the Dems at the moment.
My favorite was the letter that Elizabeth Warren and some other person sent to the Fed.
That's a base letter.
Jerome Powell, you need to drop rates.
Rates are
also be apolitical. You're not a political institution.
Hey everyone, this episode is brought to you by Namada, the shielded asset hub protecting the future of the multi-chain. Namada is a chain that's near and dear to my heart because in previous seasons of Bell Curve, we've talked about how the cardinal original sin of most blockchains is not thinking about privacy from the beginning, but also because if we want to onboard a whole bunch of applications, it doesn't work in a default transparency setting. So Namada not only brings about a better future that we all want, but it's going to help onboard a ton of new applications. So Namada introduces a novel shielding reward system. The way that it works is if you hold your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect non-rewards in return. Namada will initially support IBC and Ethereum-based assets, but eventually the idea is for this to expand into a comprehensive hub for all assets. Really, really excited about what the folks over at Namada are doing. I highly recommend that you go and check them out at Nomada.net. You can follow their mainnet launch, which is soon TM. Very exciting. Tell them that I sent you. Click the link, bottom of the show notes.
It's worth highlighting that so rates during the 2017, 2018 cut, I think we're at like 3 at their peak. And then the repo market debacle kind of forced them to pivot and cut. And then before that, I mean, I guess like in the early 2000s, rates were like close to where we are today, but like probably 100 basis points lower. But this is like maybe retrospectively, this is the largest rate cutting cycle that we will ever live through, is my view. Like
it depends on where you think it's going. Like if R star is, I mean, so that's kind of the point of what the R star is. They raise their expectations of where they think rates will end up terminally. You know, the terminal value, where will asymptote towards, and now it's 2.8%.
That's still 325 of rate cuts. Like that's more than 2017. That's more than COVID. Like the price of money is going to go down, which.
Yeah, but that still means like if it's at 2.7, 2.8, I mean that still means that a 30-year mortgage is going to be in the 4s, 5s.
Yeah, I mean mortgages are what 7 or 8% today. That's like
7 and a half.
Unfathomable for most people.
Dude,
totally.
I was talking to my parents about this, and it's funny. Like their perspective was because they just bought a place, and I was asking them about their mortgage, and when they bought their first house. The mortgage that they had was 12.5%, and they were ecstatic about that. They thought that was extremely low when they got their first mortgage, which is that's some perspective for you. That's
the other rate cutting cycle that has happened in the past 100 years. That's like maybe remotely comparable. Is you had that big inflationary episode in the 70s, and then they cut rates, and you look at what the assets that did best in the 70s were. It was gold, it was real estate. And then like stocks weren't kind of as much of a thing back then, but you had the Nifty 50, which then summarily got, executed over time. But I don't know. This is kind of what you play for as someone who invests in assets for a living. Like it's not about where rates end up in my mind. It's about the rate of change and people's expectations of where they might end up, especially at the start of the rate cutting cycle. Because like, that if Trump gets elected, like people are going to be like, we're taking rates back to the zero bound. And I'm sure they'll come up with some like ex post facto R star rationalization of why that's appropriate. But I think Trump's tone, and even if Biden wins too, they're both going to have some big economic rescue package. Is my sense. Like you had, the American Recovery Act with Obama, you had the Trump Jobs Act, you had the Inflation Reduction Act for Biden, you had literally you're just going to keep spending, and then probably with Trump you get the lower taxes as well. So it's going to be just a very stimulative environment. But that's kind of what you want.
Yeah, there was also, it's funny to go back in time and read, this is where the magazine cover indicator, there were a couple articles back in like the 80s when interest rates were above 18%. They used to call bonds certificates of confiscation, because basically all the trends that we've benefited from in the last 40 years of like rates going down, for them it was the opposite. It was like rates are only going to continue to go up, and if you bought bonds when rates were at 10%, you're like, oh, this is great. But then interest rates went up another 8.5%, and you just kept losing money on your bonds. And so people called it certificates of confiscation, because it was like you're basically catching the falling knife on bonds. And then they just turned around for the last 40 years, and they've just gone all in one direction.
I mean, you could have bought in the early 80s, you could have bought a 30-year bond that was paying out 15% a year for 30 years.
That's nuts. Yeah, I think a lot of people made a lot of money doing that. And that's why the boomers just love bonds.
Well, and then on the flip side, like one of our good friends, actually one of the guys that introduced me and Vance originally, bought a house in the middle, I think it was 21, maybe 2020. His interest rate is 205.
Yeah.
Cooked. The man cooked.
Cooked, dude.
Look, I mean, it's a good setup, I think, is the long and short of it. Rates are no longer going up. Dude, I was thinking about this last night. Remember when they were just bricking us with like 75 basis point hikes like 4 times in a row, and you just show up to watch the CPI and FOMC meetings, and it would just be visceral pain? And Jerome did not give a fuck about there was one meeting where he was like, we're going to collapse the stock market. So
that was the Jackson Hole meeting in August.
So I guess that so the Jackson Hole meeting is usually when, it's like all the central bankers of the world get together and, talk about whatever they talk about. And it's usually like the turning point, if there's going to be one in the year. I could see that one being the turning point.
Not this year. Not this year.
I'll take the other side of that.
It's too close to an election. And historically, every 4 years,
taking the other side.
Okay. I mean, the expectation is that if they're going to do one cut, it'll be in the December meeting. They're not going to touch everything's basically flat until the election happens.
We shall see.
There's actually a chart where someone compiled the data of does the Fed make changes to monetary policy in the months preceding an election? You could actually go back and see, and there's this kind of thing where they try to stay out of it and be apolitical, but in the majority of months leading up to elections, they actually do either hike or cut or whatever.
But all of those are due to reasons that you absolutely had to. Like for instance, in 2020, you had to because we were entering into a pandemic. I think a lot of it is exogenous effects, and we'll see. But I think what we're probably going to see is we're going to see cooling inflation. Inflation expectations will continue to drop. You'll start to see leading like the PPI. It was PPI today or PMI. Anyways, whatever it was today is usually an early indication because it's an input into how you get to goods and services that factor into PCE and CPI. And so we're starting to see a lot of the positive stuff that you would expect from an inflation coming down perspective. And I think you're going to see, the data massaging of all of the different jobs reports and unemployment reports, like that's going to get extra massaged in the months leading up to the election. And of course it'll get revised, but it'll get revised after November. But I think you're not going to see any of the really scary stuff unless something truly breaks. I think you're going to see the economy kind of limp along from a data perspective over the next couple of months. And there won't be a catalyst. There won't be a reason or an exogenous reason for major change.
You guys want to talk a little bit about I thought there was a really interesting story this week that got some attention, but not quite as much as I thought it deserved, which was the Solana Foundation undelegating to a couple of validators that were sandwiching users. So the context here is that the Solana Foundation, so Solana in general is a delegated proof of stake chain as opposed to Ethereum being proof of stake. And so in any sort of proof of stake system, what you're trying to avoid is massive centralization of stake. Like you don't want one single operator or entity running like 10, 20, 30% of stake, because then they can actually censor transactions. And so in Ethereum, the way that works is that you actually have staking pool operators like Lido. Some people think that that's a vector of centralization in the network, but also Lido essentially gets to create criteria to make sure that different operators, like stake is decentralized across different operators in different geographies, out of different data centers, etc. So actually, I've always kind of looked at Lido as like a forcing function for decentralization. Otherwise, like in a lot of delegated proof of stake chains, the validator set tends to be super top heavy. So Solana is delegated, which is what you see in a lot of Cosmos chains. In Solana, it's delegated proof of stake. And this is just me guessing, but I think a while ago, the Solana Foundation realized that they didn't want a super top-heavy validator set. And so they have this delegation program where obviously the foundation has a bunch of stake. And so they delegate that out to validators on the network. And also, to be fair, a criticism of Solana is that it's much harder for your average like solo staker to be profitable based on how voting transactions work on Solana. So this week, the Solana Foundation undelegated to a couple of validators that were in their network that were sandwiching users. And we've talked about this before. Jito ended their mempool solution because they were concerned about the sandwiching that was going on. And so there was some pushback to the Solana Foundation, which is like, hey, first of all, no one's pro sandwiching here, but the fact that you can even influence this, right, like stake based on some sort of philosophy is not great, right? And then on the other side, you had people like Tole and Mert coming out and saying, like, are you guys pro sandwiching? Like, of course we should be, of course we should not be supporting this.
I'm pro sandwiches.
So the last thing I'll say as well, in some of the scale for how the foundation delegation program actually works, is that what they do is they match up to 200K SOL of what other people delegate to you already. And then once you get over 1 million delegated to you, they withdraw. So it's not like they're just, because I saw some takes out there that was like Solana Foundation is king being a kingpin for their validator set. That's not what's happening. They're supporting smaller ones, and then they kind of withdraw once you get big enough. But what do you guys think about this direction and the emergence of alignment on MEV alignment on the Solana chain? Like, what do you guys think about that?
Coming to a chain near you, the alignment debate.
Alignment soon.
It's like, no, only ETH has to deal with these things. Guess what? No, these problems are all blockchains. I mean, the thing that helps Solana is, like, if you roll back the clock to the things that were controversial at the ETH Foundation, it was like, what are we going to do with staking? What are we going to do with MEV? And the distribution of stake and like the decentralization of the network meant that when users were getting the shit sandwiched out of them, like there was no coordination mechanism to stop it, but there was flash bots to basically like give these people weapons to increasingly sandwich folks on ETH-L1. But with Jito, because it's so integrated, because it's all those things, and because they're so aligned with the Solana Foundation, like, they can kind of get with each other and just be like, look, like we gotta turn off the sandwiching, we gotta turn off the mempool solution, we gotta undelegate from certain validators. But there's still probably going to be private order flow discussions between validators and people that are trying to sandwich users, and this will be kind of a whack-a-mole solution. But I do think, like, if you have Jito continue to grow its stake, which it is, and today, which I saw the stat today, is Jito is generating as much fee revenue as Solana itself. You're going to have the ability to, probably shut sandwiching down to a certain extent, or at least figure out a model that you can opt everyone into. But I do think it just highlights the power of Jito, frankly, in the network's future, especially with this delegated proof of stake and stake weighted paradigm.
It's very interesting. I think that Ethereum is just furthest along in a lot of these challenges that L1s are going to have to face.
Dude,
like
always. It's like
yeah.
These people always are like, not these people. It's just like everyone shits on ETH for the problems that they will encounter in the near future.
It only if they're successful enough.
Only if they're successful enough, right?
Mm. Here's a difference that I see in the emerging Solana alignment versus ETH alignment. What got prioritized in MEV? I'd be curious to get your guys' take on this. I do think that the first class citizens that ETH tends to prioritize is solo stakers, and that's like a really sacred decision of keeping hardware and bandwidth requirement. That's why a bunch of the early propositions of like solutions to MEV, like MEV Boost, when users were getting sandwiched, they didn't. Admittedly, the infrastructure didn't exist back then, but they redirected those profits to stakers, and they were like, all right, at least this isn't just going to arbitrageurs. Like, this is mostly going to proposers. Solana is their North Star, it seems like, is users. And I think if I was putting on my Steelman for ETH, there was a long debate about this in the Blockworks Slack this week, but the Steelman for ETH is that you'd say by protecting solo stakers, you are protecting users, because the long-term value proposition of the network is censorship resistance. Solo stakers are how we get censorship resistance. And so in the short, by not prioritizing the solo stakers, you're being short-term, kind of short-sighted, I would say. But it seems like that's a divergence in between like the approaches from Solana and Ethereum that I see in MEV. What do you guys think about that? Yes, no?
Again, it's like MEV is going to happen.
Yeah.
So I get wanting to turn it off in the near term, but over the long term, you're going to have to compete with people figuring out alternative mempools, people doing private order flow. Like, it doesn't really feel possible to say no MEV. I just don't think that's possible.
Definitely not.
And also, like, if you read Kyle Samani's tweets, like, he's acknowledged that MEV is the main form of fee value accrual for a blockchain. So there's a little bit of like, this is really important, we should have it, but also like we have to ban it. Like, there's a little inconsistency there, which is totally fine. Like, I think you figure these things out over time by changing your position and turning the dial each way. But over the long term, it does feel like solo stakers are and should be the first class citizens of the network, because really the thing that matters is the use of the asset as money.
We've talked about this. Kyle's been on Bell Curve episodes and Empire episodes as well. Talked about this, and I go back because I used to also think exactly the same thing. I was like, MEV is how these networks are going to monetize. It's instead of charging an upfront fee for compute resources or something like a gas fee or something like that, you should just there's going to be a bunch of value that gets extracted on the back end through MEV, and that should just be how these networks and applications monetize. The challenge to that is that the incentives on that kind of suck, because it's almost like, what it's like is there are some businesses where the way that they generate revenue is kind of misaligned to the users of the product. Like insurance is a good example of this, where the easiest way to juice your bottom line in insurance is just pay out less. Like, it's such a misalignment in incentives between the users of the product and how to generate profits. And that's kind of what MEV is too. It's one
way of thinking about it really, really simplistically is like, are you generating direct revenue or are you generating indirect revenue? And direct revenue is what we've seen so far is only users paying for cost. So it would be the equivalent of every single time on a social media app like Twitter, you want to send a post, you have to send a little bit of money just to pay for the AWS bill for the tweet that you then go and send out. And obviously that's not the case. But that's kind of the equivalent of what we've seen so far within blockchains. What MEV really is the Robinhood example, which is every single time you want to trade, we're going to send that order flow to Citadel, and like they're going to make fractions of a penny off of it. But if they do it with enough volume, it builds a business for them and for Robinhood in the process. It's value extractive, but like, do you really care? The other equivalent would be, if you're using a social media app and it's not not something that you actually pay for, like Twitter, but it's something that you're using for free, then indirect revenue would be advertising for social media. And so like there are direct revenue and indirect revenue use cases that we can point to in Web 2. But the one major difference is that there are very, very few social applications where direct revenue actually is something that's scalable when you're charging the end user. And one of the unlocks that I think we will ultimately have within blockchains, and all of these things I think are actually like, everybody's right. It just depends on the application. One of the major unlocks that I think will happen is when we hit a point for the first time where you can have scale and blockchain cost, where the direct revenue is actually paid for by the application producer itself. And what I mean by this is you bring down the cost per transaction to be so high, and you have fee payment, basically, I can't remember what the term is, but paymasters, and you have paymasters who pay the fees on behalf of the users. That's going to be the unlock, I think, where you start to see kind of the tide shift back towards fee revenue being something that's just as viable because it's so cheap. It's 1/1000th of a penny for every transaction that you want to put on. If you have 10 million, active users at the same time, it's costing you $100, $1,000 a day, but you're making more money than that in your application itself. And so, of course, you're going to pay the AWS bills or the Ethereum bills on behalf of your users, because you don't want to have to force people who don't have money in their wallet per se to actually pay those fees. So I think of it as being a spectrum. We just haven't really unlocked the low cost yet, where paymaster indirect payment of direct revenue is a viable option yet. But I think that's coming. I mean, we're going to see blockchains get 10x cheaper every single year for the next 3 years. Yeah. And at some point we'll hit that inflection point.
I've got a question for you guys on so one of the differences between the way that Robinhood and Citadel Securities is monetizing user flow is that there are strict, well understood regulations about not front running and things like that. And I think this is changing pretty rapidly in real time, but you just don't have those same kind of assurances when you're transacting in crypto. You're probably, a lot of the big entities aren't doing stuff like that, but there aren't really any rules around there. And we talked about this, I still love that analogy, Vance, of object permanence, people doing illegal shit and then not getting caught in the first day and thinking that they got away with it. I would be curious to see, and I think especially with the ETH ETF, the SEC and different regulatory bodies are going to start digging into the MEV supply chain. They probably already have. Clearly, there's a pretty sophisticated understanding of it already. And sometimes when we think about building these blockchain systems, we do it almost not assuming any body of law or jurisdiction, and we try to make it all cryptographically sound and all that stuff, not needing laws to enforce it. But we also do live in a society that has laws. The existing laws of the US and other big regulatory jurisdictions are going to have an impact on these systems. Even if you can do something technically in the code, it can still be an illegal thing. And so I just don't think people have talked enough about the intersection of just existing laws and regulations around this stuff and MEV.
I mean, does it feel right to have Citadel buy the order flow and have that be something that subsidizes zero commission on it's kind of fringe in my mind.
How are they making their money? It's this is free. How is this free?
But this is my point. It's okay, if you're not paying for the product, you are the product, right? And so I think we haven't gotten to the point of regulation. We haven't gotten to the point of rules. Citadel at some point, I'm sure, had some really expensive lobbyists define that they could buy the order flow and have that be illegal. Payment for order flow is completely legal. There's no question about that. It's just, does it feel right? And so I think the indirect stuff is going to be a little bit more kind of fringe nefarious until there's clarity. And you kind of have to trust in they're not front running, hopefully. Wait, are they?
The payment for order flow stuff, I've noticed this thing that finance is complicated. And sometimes ordinary people will get a hold of something like payment for order flow and say, this doesn't feel right. You're front running us. And finance people will say, no. Technically, we're not front running you. And they'll be like, you dumb civilian, you just don't understand. But they are front running you, just in a more complicated way. So
this is my
technically they're right. Yeah, they're not directly front running you, but you're getting screwed somehow. You just don't really understand it. So,
but also you want to buy a coin, that's your prerogative. And I would rather have your ability to buy a coin be unencumbered than enforce some rule where we have to route order flow through a market maker that can turn off at some point. And this is the whole GameStop thing where they turned off the buy button.
They did.
That's so fucked up. I would much rather be front run or have slippage than have some sort of no liveness situation. And that's kind of gets back to why the decentralization actually matters. you need to preserve the ability to have that versus like if you're dictating who can sandwich and who can, do this, that, and the other thing, like, sure, you might align yourself short term, but long term, you're building something that looks a lot like the existing financial system.
I think one of the challenges that L1s have is that they don't have a stick. Like governments have, what governments are trying to be, governments often step into places where there's no, like the free market isn't capable of solving some things. Like mortgages are a good example of an area that the buyers and sellers don't necessarily line up, but the government says like it's a good for people to be able to own homes, and like they came in and they basically backstopped the entire mortgage market. And there are other areas like this, right, where like this is why we have like an FDA and stuff like this. I know there are probably some anarchists listening to this saying the government shouldn't be involved in any of that. Like, no, I think there are some areas where government has to be involved, and the way the government effectively mediates these sort of neutral solutions is with like fines and jail time and stuff. And one of these things that is just
you're going
really
to blockchain jail. You're going to blockchain.
Yeah, you got to block. But that's the
5 minutes.
but that's the tough thing. I have so much empathy for the Ethereum Foundation, which everyone just casts as being this like shadowy Illuminati in charge of the chain. It's like they're just trying to do a lot of stuff that the free market doesn't solve. Like they're funding client teams. Like they're trying to solve, like, push MEV in a good direction. But it's tough if you don't have any stick. All they've got is carrot.
I just got the funniest mental image of, when you lock out of your iPhone and it's like you're stuck and you can't get your password right right. And it's like it goes 2, 5, 10, 30 minutes, an hour. It's like the more times you do nefarious shit, your account gets blocked.
Yeah. That would be funny.
The thing though is like, I wonder, I mean, okay, blockchains are very, in the world of like governments versus blockchains don't have to deal with like 99% of the shit that governments do.
You're right.
And so you do have the ability to have, the simplistic homogeneity of situations be something that doesn't necessarily require a stick, I would say. Also, I think you don't necessarily need a stick in this instance because I think blockchains are self-regulating at a rate that is so much faster than governments that you can have an so, the Ethereum Foundation, a steward of the Ethereum community and the Ethereum protocol, they can make changes, and it's not going to happen in a week or a day or something like that, but it'll happen. It'll go into the next hard fork, which is maybe a year away. And those are massive changes to the Ethereum protocol and the Ethereum ecosystem. And so I think if you start to see something really bad happening, it's self-healing, in that respect, which, it's not a stick per se, but it is a better carrot.
Yeah. And I think you're right that it's a good point that blockchains don't have to deal with the vast majority of the stuff that governments have to deal with. Like,
let's put FDA on chain, see how it works.
Let's talk about ETH for a second. This tweet from Sassel, if you want to throw it up on the screen.
I mean, I think the basic description of this is a graph of the J curve working.
Yeah, I mean, EIP 4844 obviously reduced fees for ETH in the aggregate. Deflationary status has faded a little bit since its inclusion, but it feels like the main thing that's powering this, I mean, the main thing the market is kind of fading or nervous about is like, is this ETH L2 roadmap going to work? And I think the ETH L2 roadmap is like somewhat like the OG Cosmos vision of you have a fee generating L1 and then you scale, the network effects around, the base asset, which is ETH in this case, to the L2s. And then the L2s, are themselves generating fees. Like base is an example of this. And then they pass them back to the L1 once they net settle their transactions. And this is working. And I think you're going to see a lot more corporate L2s. And this is kind of like the thing where it's like, even if you made a blockchain fast and free, would that be the optimal model? And I think there is like this profit incentive that's missing for like, could base build, on Solana and have the same sort of revenue generate? And like, no, you can't have that. So you kind of need to build towards this L2 roadmap. And people have been fading this as probably not viable, but this is the start of what I think is going to be the resurgence of, okay, the L2 roadmap works. And once people clue into that, like, I think this is like my personal thinking on like how ETH flips Bitcoin is that people start to realize this. You have a lot more corporate chains, you have a lot more use of ETH in these bridges, and ETH is money. And it's just good to see that this is trending up. You know, more of the same, I think, in the future.
I have so I agree. I think that I basically think the TLDR is that there's been a ton of ETH FUD recently, and I think that'll all change once the ETF goes live and the price starts moving. But I think that the only thing that I find tricky about the current ETH L2 roadmap is the amount of L2s that exist and the interop in between those. And I would be an advocate of, one, the EF prioritizing something around interop. Like, this is, I think, one of those things where the EF or Ethereum is going to have a more opinionated interpretation of what interop should look like on these chains. And I kind of think that the approach that ETH has gone down is like the free market of competing of different. So like, I think the most viable future for the ETH L2 scaling roadmap is like maybe 3 or 4 frameworks like Optimism, Arbitrum, whatever, and they're just interoperable with one another with some sort of enshrined bridge or something like that.
But it feels like we're going to do the competition thing on the bridging and like there's like, you know, CCIP, there's socket, there's across, there's other message passaging, and like you saw Vitalik tweet, he's like, you know, today's FUD or tomorrow or yesterday's FUD is today's solved problem. Like, he is feels like very clued in to the Twitter discussion, which is good. And I mean, maybe once we study what is exactly in the next hard fork, I've just seen that there's a ton of stuff in it that will directly impact UI UX, and this is kind of what ETH does. They just ship, and they're not oftentimes the first mover on a lot of stuff. Like proof of stake originally was Cosmos, you know, but they kind of they perfect it, and so looking forward to seeing more of that.
It's the Apple approach to innovation.
This is literally what I was just thinking.
It's like, we're going to wait for all the tech to play out, and then we're going to build a product with it.
Looks like they're running that playbook back on, I don't know if you saw that there was the Apple Intelligence, which is their integration with ChatGPT. I think it's pretty smart. I don't think they could come out. So Apple, not to
no.
go too
I think we're good on ETH. Like that was the main thing I want to talk about.
Last thing on ETH is there was a tweet I saw this morning where Gensler made comments that the S1s should go live sometime this summer.
Oh yeah, I saw that. Yep.
So would that mean it starts trading this summer?
Yes.
Got it.
Awesome.
We love it.
That's going to line up pretty interestingly around the election, potentially the beginning of rate cuts, or the market starting to price rate cuts in at ETH ETF. That could be pretty nice. Pretty nice.
Nice.
It's going to be a busy end of summer and fall.
Yeah. I mean, maybe Gensler is just, you know, he's timing it for that when everybody comes back late August, early Sept, and it's on. Those are always the most heady times of every year. It feels like it like starts in September, August, and then kind of like October and like takes a little breather, and then it like accelerates through November and December. So hopefully it'll be a good Christmas this year. Presents for all the nice little boys and girls.
Well, on the theme of the election, so Trump was tweeting out in Truth Social this week.
Oh yeah,
which was,
let's talk about this.
This is pretty wild, man. I mean, he keeps doing these things which are, it would be extremely bullish if a lot of these promises ended up getting followed through on. But you know, this is the exact quote from the tweet: "Vote for Trump. Bitcoin mining may be our last line of defense against the CBDC. Biden's hatred of Bitcoin only helps China, Russia, and the radical communist left. We all want the remaining Bitcoin to be made in the USA. It will help us be energy dominant." I mean,
I love what he says, the radical left. It's like so funny.
Yeah. And I mean, this is just pretty wild that a US ex-president, but also, you know, the GOP candidate is saying this kind of stuff. I mean, this is just such a radical departure from what we've had basically the entirety of Bitcoin's and crypto's existence.
Dude, we used to get bowled up over Enterprise Ethereum Alliance announcement.
Because Nissan
Toyota's joining.
Blockchain and Transportation Alliance, baby.
Oh yeah,
Blockchains.
we're gonna tag the shit out of these strawberries and ship them somewhere, and we'll have perfect tracking on where they go because it's on chain, right? No, I mean, like, I think that the market is not pricing in how bullish the setup for crypto is. Like, the guy who's probably going to be the next president is tweeting out, "We need to keep all the bitcoins in the country." What are we talking about? Like, it's yeah. I mean, one thing I was talking about with Michael is so the S&P is at record highs. Crypto's like just below its all-time high. How do you think about that? How do you think about the majors versus the alts in crypto itself? And I think, each cycle, you need the stock market to run super hard for things to get so expensive that people look at crypto and they're like, there's some bargains there. You need to have stuff going on in crypto. You need to have that belief. But like, feels like we're building to get there. And so like, I think once the S&P hits like 55, 6,000, like it's going to be crypto's time. And then because natives own less and less of the majors each cycle, which makes sense. Like they sell them to TradFi, they sell them to, new people. Like the wealth effects you need in crypto to generate a real alt season, like you need the majors to run just like the S&P needs to run before crypto gets attention. You need the majors to run before the alts get attention. And so it just feels like we're basically replaying the prior cycle when cycles just like at aggregate higher price levels. It's a good setup.
So here's I saw this from Chow over at Alliance, but the tweet that he said is idle thought. Trump getting elected is probably bullish for alts relative to BTC. Reasoning: Trump has a knack for unleashing animal spirits in risk markets. BTC is basically the only crypto asset that unaffected by current regulatory oppressive regime. And to your point, Vance, I think that every time the rationale is different. Every single time there's a different thing that's driving it and why it's never going to happen again. But I think the headline story of this cycle so far is exactly like the last cycles. There's just different rationale and all that stuff. Like it's just playing out extremely similarly to last time.
The other angle I put on this is, and I'm not sure exactly how, I think it's actually not the presidential race itself, but more what's going to happen in the Senate. But there's probably a lot more bullish perspective if you see the Senate flip to the Republicans, just based off of some of the things that we're hearing about conversations around Fit 21, and that there actually are constructive conversations going on in the background. In Fit 21, bipartisan support in the House would provide a framework for how basically like all long tail assets, entrepreneurship in the Web3 space can happen in the United States broadly. It's a seminal piece of legislation, and it still needs work for sure, but it's definitely getting directionally where we want it to go. The likelihood of that passing in a very constructive manner goes way up if you see a Republican Senate.
I agree with you. Yeah. It's, it's tough to predict. Like politics are just not my, no good at predicting this stuff. But yeah, it just does seem like people are, to end with where we started. I think people are really unhappy with the incumbents. And there's this effect of who you're going to believe, me or your lying eyes, where we're just getting told that everything is great. And I think people just their lived experience is not matching up with what they're being told. And whenever that happened. And also historically, inflationary regimes are horrible for incumbents. Like inflation just turns over incumbent parties like nothing else. Like people hate it. It sucks. So
yeah, I mean, if you're sitting at home and you're wondering what data to look at, you should just go on Real Clear Politics and look at this stuff. And one is a few general rules of thumb. Generally, you need Biden to be up 2 to 3 points in the popular vote to win the battlegrounds. And, he's down in the popular vote right now. You should look at the battleground states, specifically Pennsylvania, Michigan, and Wisconsin. And then the last thing is looking at approval ratings. There's no president that's ever been reelected with an approval rating below 39%. And Biden's at 37, 38, depending on which site you use. So, it's not one-sided in the bag to any extent. There's a lot of things that can change, but usually what you see is that the things that solidify in June in terms of polling and approval rating are pretty concrete throughout the rest of the cycle. So
here's a question. We're exactly 2 weeks out. Today's June 13th. We're 2 weeks out from the first presidential debate. Polymarket has the odds of Biden dropping out at 25%.
Way too high.
What are your takes?
Way too. There's no way he drops out at this point. I don't think that just wouldn't be enough time to. Who are you going to put in there? I guess you could put in Gavin Newsom.
I'm bearish on Gavin. I mean, the race is close enough where, you know, if Biden does well in the debates, things could shift. Like, he's not getting blown out by like 20 points in these battleground states. I just think the likelihood of him dropping out is very, very low.
I mean, he's getting blown out 20 points in who's going to be president on Polymarket.
He is, but I'm not sure he's following those odds. The Polymarket bettors, you know, I wouldn't call them like political geniuses. So like you probably have some overestimation there. But you know, like there was a funny 538 model that got put out this week, which reminded me of that David Beckham, Victoria Beckham meme. Where he's like, I grew up middle class, and he's like, just be honest, like, you know, what car did you drive to school? And she's like, it was a Bentley. and so like 538 put out this model of, you know, they have like fundamental weighting, the economy, the unemployment rate, and then they have like the polls. And you know, they published this model this week. There's a 53 out of 100 chance that Biden wins, which is far lower than The Economist, which has Biden at 33% chance. And then they did this podcast where this guy was like, okay, well, like, you know, say you took the fundamentals out of the model, which I don't think fundamentals have any business in a like political polling model. He's like, well, like we can't really take them out and blah, blah. He's like, okay, just like pretend you took them out and ran it. What would it be? He was just like, it'd be 80% Trump. But come on. So
yeah, that's ridiculous.
You know, I think even the pros are pretty bearish on Biden's odds at the moment. Even the ones that are like very, very liberal, which is like a pretty incredible tell.
Yeah. Well, fellas, I know we got to wind down a little early this week. I do want to, one thing that I'm looking forward to maybe just give a little plug. It seems like we might now be doing a live bell curve panel. At
I was going to say.
Let's do it.
Yeah.
We should do some of these as streams, by the way.
Huh? Say again?
We should do some of these as streams.
We should. You know what? Remember in the beginning we had this vision of like a Friday afternoon, like with beers type of thing. I've noticed some of our analysts going in that direction. That would be fun. Like the 0x research. I got a long message being like, it needs to be more casual. And the next thing I saw on 0x research, it was like, we're doing like beers and something, like they're live streaming on it's like, that sounds really fun actually. So maybe we could do that with bell curve. But you know what else was fun at DAS? Shout out to everyone that came to our meetup at DAS.
Yeah,
but
that was great.
We gotta connect with the bell curve nation. So we'll set something up for.
I was gonna say we're definitely doing that in Salt Lake. Come October, but the live on stage pod definitely gonna happen in October.
Live on stage pod's gonna be a blast. Hell yeah. All right, everyone. So hopefully we'll see y'all out there. And yeah, guys, another fun one. We'll see you boys next week.
Later.
Hey, everyone. Hope you all enjoyed today's episode. Want to give a final shout out to Namada. Again, a team that is near and dear to my heart. They are building the Shielded Asset Hub, which is protecting the future multi-chain. Talked a little bit about how that works in the mid-roll. But for now, what I would highly recommend that you do is go check them out. They're in their mainnet launch phase. You can follow along with everything at Nomada.net. You can start rewarding yourself by shielding your actions and strengthening data privacy for all across the multi-chain. So thanks again, Namada, for all the great work that you're doing.